So, have you ever looked at the stock market and just felt completely lost?
Like you're walking through a dense fog or something.
Exactly. You're nervous, you're not sure what to do, and you're just convinced that, the big money players have some secret you don't.
Hmm.
If that sounds familiar, then this deep dive is absolutely for you. We've got a really powerful stack of sources today that lays out a detailed game plan. It was designed by William J. O'Neill and then refined by Matthew Galgani.
And we're basically offering a shortcut. Not,
Mhm.
not to instant riches, but to market discipline.
And that discipline is what actually creates the wealth.
That's what the sources argue, yeah.
That's the real mission here because the authors are very clear. We have to stop focusing on the individual trees, all the daily stock moves,
The noise.
all the noise, and first, understand the forest, the big picture market strategies. So our goal for you is simple. Deliver a clear, actionable path so you can stop being at the mercy of the market.
And that feeling, being at the mercy of the market, that's the core emotional problem this whole methodology is trying to solve.
Right.
The big epiphany for so many successful investors is just realizing they don't have to be paralyzed by fear. The answer is having a game plan, knowing when to invest, how to lock in your profits, and this is the big one, simple sell rules so you don't have catastrophic losses.
Okay, that takes us right to the safety net, the absolute non-negotiable foundation. Capital preservation comes first. So what are the two ironclad rules to protect our money?
The first rule is probably the toughest emotionally, but it is the most crucial.
Okay.
You have to cut all losses at no more than 7 to 8% below your purchase price, no exceptions.
Wow, 7 to 8%. That feels incredibly harsh. What if a stock is just having a volatile week?
It feels harsh, but if you don't do it, you become the cautionary tale. Look at a stock like Dry Ships. It had this spectacular run-up, but the investors who didn't respect a small loss rule, they just watched in horror as it dropped from $130 down to under $2.
Oh, that's brutal.
It's portfolio crippling. When you fail that 8% rule, a small setback becomes a mistake you just can't recover from. Not the time and not the money.
So the cost of not acting is way more painful than the cost of just being wrong on a trade.
Exactly.
Okay, so what's the flip side? What's the rule for our winners?
Rule number 2 is simple. Take most of your profits at 20 to 25%
To lock them in.
to lock in the gains. Yeah. So many people see a 30 or 40% gain and they think their genius is right. But then they get greedy, they ride the stock all the way back down, and that great winner turns into a small loss or a break-even trade.
Mm-hmm.
The whole methodology just demands you secure that gain when the stock is actually working for you.
Cut your losses short, let your winners run, but not forever. You have to lock in the profits.
That's the foundation.
So now that we have our safety net, let's zoom out and look at the whole forest, the market environment itself. Okay, so let's unpack this.
Sorry.
We can find the best stock in the world, but if the whole market is collapsing, it's just fighting a massive headwind,
A
right?
huge headwind. Yeah, the market cycle is the biggest factor. It determines everything. If you should be aggressive, defensive, or just sitting on the sidelines in cash.
And how do we define those cycles?
Well, a decline of 20% or more, that's a bear market. Anything less is just an interim correction. And what's critical to remember is that bull markets usually last 2 to 4 years. But bear markets are pretty quick, usually only 8 to 9 months.
I really like how the source material frames this. It says a market correction is like a forest fire.
It's a great metaphor.
It's painful, but it's necessary. It clears out the weak companies, the over-leveraged players, and it sets the stage for new, innovative growth to come through.
And this leads to a really counterintuitive truth. The best time to invest, when you make the biggest money, is in the first 1 to 2 years of a new bull cycle.
Right.
And those new uptrends almost always begin when the economic news and the public mood are still just terrible.
You mentioned March 2009. That was peak panic after the financial crisis. So how do we, as disciplined learners, tell the difference between just a short-term rally in a bear market and a real confirmed new uptrend?
We use a specific confirmation signal. It's called the follow-through day, or FTD.
FTD. Okay.
So when the market is trying to rally off a bottom, we watch the rebound attempts. Day 1, day 2, day 3, you might get small gains. The FTD is what confirms it's real, and it usually happens after day 3, often on day 4 through 7 of the rally attempt.
And there are two criteria that make it official, right? What are they?
Right. First, the index has to have a big one-day price gain, usually 1.5% or higher. But the real key, the institutional confirmation, is the volume.
Ah, the volume.
That big price gain must happen on volume that is heavier than the day before. That surge tells you the elephant in the bathtub, the big institutional money, is finally coming back into the market. It validates the rally.
So that's how we know when to get in. What about spotting the early signs of a drought? How do we know when that institutional money is starting to leave?
We track that with something called distribution days. You see big investors, mutual funds, pension funds, they drive about 70% of the market.
Mm-hmm.
And their selling volume is just too big to hide. So a distribution day is when an index closes lower on volume that is heavier than the prior day. It's the exact inverse of that follow-through day.
So what's the actionable number? How many of those do we need to see before we start getting defensive?
The sources suggest that when that count hits 4 over a rolling period, you should look for something to sell. Start with your weakest stocks. By the time the count hits 5 or 6, a lot of the leading stocks might already be getting hit pretty hard.
I see.
We saw this exact pattern in 2007. The distribution days were piling up, signaling that institutions were quietly heading for the exits long before the huge correction really took hold. It keeps you proactive, not reactive.
All right, so we've shifted from the macro view of the forest to the micro view of the trees, finding those truly great individual stocks. And the source is crystal clear on this. You can't just cling to last cycle's winners.
No, because only about 1 in 8 stocks will lead in back-to-back bull markets. You have to hunt for the new leaders.
Which brings us to the core of the CAN-SLIM system and what the sources call Big Rock number 2.
Yep, focus on companies with explosive earnings growth that's being fueled by true innovation.
Let's define explosive, because we're not just talking about steady, predictable growth.
No, not at all. We need strong, and this part is critical, accelerating earnings per share growth. So like 25% or higher in recent quarters and a 25% plus average over the last 3 years.
We're also looking for a high return on equity, or ROE.
Right, an ROE of 17% or higher. That number really tells you how effectively a company is using its shareholders' money to generate profits. It separates the good from the truly dynamic.
And what fuels that growth is the N in CAN-SLIM, the new innovation.
And this isn't just a small product tweak. We're talking about game changers. Things like, Apple's iPod and iPhone, or Home Depot's whole big box store concept.
Yeah.
Even going way back to Brunswick's automatic pin spotters that completely changed bowling in the 50s.
So the N means newness is driving demand, but, and this seems important, it has to be proven demand that you can see in those accelerating fundamentals.
Exactly. The Facebook IPO back in 2012 is the perfect cautionary tale. It had everything. It was new, it was dominant, the hype was massive.
But it was a disaster for investors. It dropped 50% right after the IPO. If it was so new, why did it fail that fundamental check?
Because the fundamentals were actually getting worse. Before the IPO, Facebook had 3 straight quarters of decelerating earnings. The growth rate dropped from 83% to 17% down to 9%.
Wow.
So the hype was there, but the proven growth you need for a big run was falling apart. If you just stuck to the rules, you would have avoided that crash completely.
That story really drives home the importance of the third big rock, institutional sponsorship.
The ultimate validation.
If the big funds aren't buying, your stock just doesn't have the fuel to make a massive move. We have to follow the elephant.
And we track that in 2 ways. First, you look for a rising number of funds owning the stock from one quarter to the next. That tells you new money is flowing in. We saw that with stocks like Ulta Beauty and Watson Pharmaceuticals right before they had huge runs.
That's the second way.
Is the accumulation distribution rating. It's a simple A to E rating that tracks whether institutions have been net buyers or net sellers over the last 13 weeks.
And the rule is simple, I assume?
Very simple. Only target stocks with an A, B, or C rating. If it's a D or an E, the big funds are actively selling, and you just have to stay away.
Finally, let's just bust a huge market myth. We're always told to look for cheap stocks based on their price to earnings, or PE ratio.
It's a myth. Our analysis shows that PE ratios are just not an important factor in what drives a stock's price. When you focus on explosive growth and new innovation, you'll often find stocks with higher PEs, and that's perfectly fine.
Don't fear the high price tag.
Right. Don't let a cheap PE fool you. Priceline was at $270 a share before it ran up 182%. Apple was $150 before a monster run. Focus on the CAN-SLIM trades, not the PE.
So we found our leaders using this checklist, but the real challenge now is execution, isn't it? It's discipline. As Aristotle said, excellence is not an act, but a habit.
Exactly. Success in investing demands a consistent routine, something that helps you identify these opportunities, but also respects that you have a busy life. The sources lay out two key habits: the simple weekend routine and a 10-minute daily routine.
Okay, so what's the focus during that weekend prep time?
The weekend is for your research. You review the market's health checking that FTD and distribution day count, and then you scout for new stocks that are just starting to emerge from sound chart patterns.
So you're building your watch list for the week ahead.
Exactly. You can identify potential leaders before they break out and map out your entry and exit points ahead of time.
And the quick 10-minute daily routine, what's that for?
That's just for maintenance. You do a quick check on the market status, and then you review your current stocks to make sure they're holding up on price and volume. If any stock hits that 7 to 8% loss rule, the decision is already made for you. You sell.
No hesitation.
It prevents that emotional second-guessing.
A huge part of this routine is reading charts. And charts aren't just, squiggly lines. They're telling a story about what the big institutional money is doing.
That's right. The combination of price and volume clearly shows you the elephant's movements. And institutional buying tends to form specific, repeatable patterns before a stock makes a big move.
Like the classic cup with handle.
The cup with handle, yeah, which looks just like its name. A big U shape with a small, tight handle on the right side. And then there's the double bottom, which forms the W shape. That one often shows up when the broader market has been really volatile.
And let's highlight what might be the best signal of that quiet, sustained institutional buying. The 3 weeks tight pattern.
Yes, this is a powerful one. It's a short, very tight pause after a stock has already had a big breakout. The weekly closing prices are all within about 1% of each other for 3 weeks.
What does that tightness signal?
It signals that the institutions are holding on to their shares and quietly buying more. They're getting ready for the next big leg higher.
We also have to remember that no stock exists in a vacuum. Almost half, 49% of a stock's move is driven by the strength of its industry group.
That's a huge number. Institutional money flows into groups that are benefiting from the big economic trends of the day. For example, back in the struggling economy of 2010, funds were pouring into discount retailers.
Right.
So if you followed that industry shift, you would have found stocks like Ross Stores and TJX companies, which were leading their groups and delivered massive returns.
Okay, one final critical point on execution. Earnings season. A big risk zone.
A huge risk. The rule is simple. Never buy a stock right before it reports earnings. It's basically a coin flip. The stock can swing wildly either way, no matter what the experts are predicting.
So you wait for the market's reaction.
You wait. If the stock gaps up on heavy volume after the report, confirming the good news, that's your buy signal. If it sells off, you just avoided a potential disaster.
So to wrap all this up, I think we should remember the words of the great trader Jesse Livermore. He said, "The only way you get a real education in the market is to invest cash, track your trade, and study your mistakes." Investing isn't a theory you read in a book. It's a skill, and it requires continuous practice and review.
And if we go back to that forest versus trees idea, the real high price you pay for holding on to losers, like that dry ships example, it isn't just the 7 or 8% loss.
Nah.
It's the profound opportunity cost.
Sure.
By clinging to that broken stock, you are missing the massive gains from the new leaders, the Chipotles, the Ulta Beauties, the SolarWinds that are just taking off in the next bull market.
Discipline is the price of admission to those winners. You have to focus on the routines and always focus on the facts you see in the charts, not the opinions you hear in the news. If you found clarity in these rules and you feel like you finally have a game plan to approach the market, hit that like button to help other learners find this deep dive. Definitely subscribe for more knowledge shortcuts and share this with anyone you know who still feels nervous about navigating the market.
And here's the final provocative thought, the ultimate takeaway from all these sources. All stocks are bad, except the ones that go up.
I like that.
Even a great company with a great product is a bad stock if institutional investors are dumping it. So you always have to focus on what the money is doing, not what the news is saying.